Derivatives are financial instruments that derive their value from an underlying asset or benchmark. These instruments are widely used for various purposes, including hedging, speculation, and arbitrage. While derivatives can offer benefits such as risk management and increased liquidity, they also come with significant risks. Below are some common types of derivatives and a detailed explanation of their associated risks. Futures contracts. Futures contracts are agreements between two parties to buy or sell an asset at a predetermined price and date in the future. The underlying assets can include commodities, currencies, stock indexes, and more. Risks. Market risk. Futures prices are influenced by the underlying asset's price movements. If the market moves against a position, significant losses can occur. Leverage risk. Futures trading involves using leverage, which means a small price movement in the underlying asset can lead to substantial gains or losses. Counterparty risk. There is a risk that the other party may default on the contract, leading to potential losses. Margin call risk. If the value of the position falls below the required margin, traders may need to deposit additional funds to meet margin requirements. Options contracts. Options give the holder the right, but not the obligation, to buy, call option, or sell, put option, an underlying asset at a predetermined price, strike price, on or before a specified date. Premium loss risk. Options have an upfront premium cost, which is at risk if the option expires worthless or is not exercised. Market risk. Like futures, options are affected by underlying asset price movements. Time decay risk. Options have a limited lifespan, and their value diminishes as they approach expiration. This time decay can lead to losses. Implied volatility risk. Changes in market volatility can impact the value of options, potentially leading to unexpected losses. Swaps. Swaps are agreements between two parties to exchange cash flows or financial instruments based on specific conditions. The most common types are interest rate swaps and currency swaps. Interest rate risk. In interest rate swaps, changes in interest rates can lead to variations in cash flows, affecting the profitability of the swap. Credit risk. Swaps are bilateral contracts, and there is a risk of one party defaulting on its obligations. Basis risk. The underlying assets in a swap may not perfectly match, leading to basis risk where changes in their prices diverge. Forward contracts. Forward contracts are similar to futures contracts but are not standardized or traded on exchanges. They are customized agreements between two parties to buy or sell an asset at a specific price on a future date. Counterparty risk. Similar to futures, there is a risk that the counterparty may default on the contract. Liquidity risk. Forward contracts may be illiquid, making it challenging to close out positions before the maturity date. Credit default swaps, CDS. CDS are used to protect against the risk of default on debt instruments, such as bonds. Credit risk. If the issuer of the underlying bond defaults, the CDS buyer may suffer significant losses. Basis risk. The CDS may not perfectly match the underlying bond, leading to basis risk. Options on futures contracts. These are options contracts based on futures contracts as the underlying asset. Futures market risk, similar to options on securities, but influenced by futures contract price movements. Structured products. These are complex derivatives that combine different financial instruments, often with embedded options. Complexity risk. The complexity of these products can make it challenging for investors to fully understand the risks they are taking. Market and credit risk. As with other derivatives, they are subject to market and counterparty risks. Exchange-traded products, ETPs. ETPs include exchange-traded funds, ETFs, and exchange-traded notes, ETNs, which derive their value from underlying assets or indices. Tracking error risk. ETPs may not perfectly track the performance of the underlying assets or indices, leading to discrepancies. Liquidity risk. ETPs can be subject to liquidity issues, especially in volatile markets, impacting their tradability. It is essential to recognize that derivatives trading involves substantial risk, and investors should have a clear understanding of the instruments they are using, their risks, and their potential rewards. Novice traders should approach derivatives with caution and seek advice from experienced professionals. Risk management strategies, including the use of stop-loss orders and position sizing, can help mitigate some of the risks associated with derivatives trading.